Hello, today is Thursday, the 21st day of February 2013, and I want to talk about the Death Cross, as that's in the news right now within gold. And here's an interesting chart going back to 1969 and the July 29th date. That's when Death Cross occurred. This data is from the LBMA website. They have data going back to 1968, where this is the AM fixings price. So anyway, with that being said, the price was 41.49. The 50-day moving average went below the 200-day moving average, and prices crashed large, big time. And then on September the 2nd, 1970, the 50-day moving average rose above the 200-day. They call that a golden cross, hence the name gold. Why would they call it a golden cross, or his word is as good as gold, or all that type of stuff? Yeah, that should tell you right now what the future kind of holds. But what we're going to do is take a look at every single, for the most part, every single death and golden cross there has ever been since this time frame. We're going to show you every single one but one. So let's continue on further. We can see here there's a death cross here, but this one didn't do what the last one did. No, because the last time we see the thing just sink when the 50-day moving average went below the 200. On this occasion, it fell below it, and then shortly after that, you see the golden cross. And here's a situation again where you have a very fast death cross, just barely going underneath it here, and then back above it quickly afterwards again. So in this situation, if you were to sell at 156 and then buy back at 177, you wouldn't be doing so well. So sometimes this strategy can work, sometimes it doesn't. We're going to show, like I said, we're going to show every single one of these. And then after we're done, we're going to show how well it is to, in fact, sell every single time you have this death cross and buy back in on a golden cross. This is one of the situations that would work. Let's continue on further. We're now into the 1980s. Moving on now to the end of the 1980s into 1990. And moving on, so on and so forth. And on September of 29th of 1995, there was a death cross at 383.75. That's the only one that was missed within this chart, and it was just right after this thing ended. So what ended up happening is this thing started to fall down, obviously down to here, and the yellow line went lower. And there we have the situation of a golden cross, followed by another death cross, and so on and so forth. We're now into the 2000s. Bull market has begun. And then, of course, right here you can see in 2008, you had the bearish cross in September, which was 1 month before the bottom for the most part. And it obviously regained it very fast, although it did go down from 794 to about 694, so it did go down another 100 at that point. But if you're using a simple strategy to sell here or buy here, you lose. If you're a little bit more advanced or intermediate and you have the numbers game in your favor, well, then you know exactly what you're doing. Now we finish this off to where we are right now. On the 18th day of April, the bull run ended with a bearish move, or a bear cross, but, well, it went down another, again, just like in 2008, another, about 100 or so, but then obviously regained it, and we can see here that the 50-day moving average is going down below the 200. Now, technically, within this particular data, it has not crossed. I'm sure some other data forms have, and it's probably going to cross tomorrow. And maybe it will scream out short-term lower prices. After all, we are entering the lower end of this range. And, well, there's still a little bit to go, but only 3-4% as this point. And then the next support level, roughly at 1,400. Okay. So now let's take a look at this, how you would do if you were to buy on every golden cross and sell on every death cross. And here's what the action would look like. Starting with 1,000 ounces of gold and buying when it was $35 an ounce back in the day, you would notice you'd have a small gain early on, getting up to about 1150, down to about 650, so you lost about 40% of your value. And then you did better than double, going from 650 to about 1600. But since then, 1600 back down to about 1,000. So it depends on the situation. But overall, since 1968, you've done about 1% better, almost 1% better, by buying and selling within these situations. Definitely not data you can go on to say if it's a winning strategy or not when you're using just about 21 different buy and sell transactions and the net result is flat. Therefore, again, it's hard to outperform a market that's already very stout, to say the least, but there are ways of doing such. Finally, I want to go over a piece of an article within the Death Cross, so one paragraph within it, and this paragraph reads, or the part within the paragraph reads, what's really behind this is we've had three major risks that supported the gold market last year, which was the fiscal cliff, the possibility of Greece leaving the euro and the eurozone crisis, and the third was a hard landing in China. And all of these risks have mitigated this year, said Jim Steele, Chief Commodities Analyst at HSBC, and I think that has undercut the bullion market. Okay, quite frankly, those are none of the three possibilities why I think gold is that of a good investment, / same with silver, of course, because of a fiat debt note that was really a note that people had no idea about its fundamentals and really how it's created even just a decade ago. Now, the information within the internet mainly has spread out so fast, although people have chosen not to learn this information or understand it. So that's the negative part about gold, or the only reason I would say not to get out of the dollar is people's inability to understand. But is that inability going to stay? Again, time will tell. I don't think that would be the case. So therefore, because we have a fiat debt note that is simply relied solely on debt, thus a lot of bad results will follow from it. And then, of course, the creation or addition of such to the degrees that, well, if you look at the national debt, it's skyrocketing, and it's no hidden secret that the reason gold going from 35 to 1900 has a lot to do with the inflationary cycles. You look at how much anything costed 150 years ago, nothing like that today. So that would be the main and really only reason why I would support that gold market. But you don't expect CNBC to explain to you how currency is created. They have been avoiding that every single day for the last multiple years. This information has been spreading on YouTube, and it's been spreading since around 2007. So thank you for tuning in, and have yourself a great day. Bye-bye.